Hello, in this lecture we will continue talking about Chapter 22. We're moving on to the master budget components in this case. So here's the master budget overview. So we're going to have to do these components in this order, and we'll explain why as we go. These are the components or the pieces of the master budget. We're going to start off with the sales component, meaning we're going to start off deciding how many units we're going to sell and what the sales price will be. We have to start there. Why do we have to start there? Because if we're in a manufacturing company, then we need to know how many things we're going to sell before we can think about how many things we're going to need to produce. And also, by the way, we are going to talk about a manufacturing company here, and that's partly because the manufacturing company is the largest and most difficult type of budget. But if you had any other type of budgeting process, these principles would apply for the most part. We just have to trim it down, take out the pieces that would not apply, which would be obviously the manufacturing type of areas. So in the manufacturing process, we need to first figure out what we think we're going to sell in the future. Then we can figure out what we think we need to make in order to cover the sales that we were going to need in the future. Once we do that, then we can start thinking about the materials that we'll need, the labor that we'll need, and the factory overhead that we'll need. So if we were building guitars like we were looking at, then we need to know how many guitars we're going to be able to sell, then how many guitars we're going to need to produce, then we're going to need to know how much wood we'll need to buy, how much labor will need to go into that, how much factory overhead is going to go into that. Those will be the next areas we can take a look at. And then we can put together our cash budget. Now note that when we think about the budgeting process, we probably think mostly of kind of the income statement because we're thinking about time period, how we're going to do over time. And that's generally going to be thinking of the income statement, our performance over the future, the next year that will be happening. Also note that we will be taking a look at the cash over time as well. What will be our cash flow situation over time very closely, because cash is going to be a very important account. And remember that the budget, our financial statements are on an accrual basis, and therefore we're going to have to also take a look at the cash basis, the cash budget. Then you note that we have this line out here going to the corporate capital expenditures, generally being larger type of expenditures. So if we plan on buying a larger piece of equipment or this type of thing, investing in the company, then we're going to have to do a budget for those types of expenditures. And then we've got this coming out over here, and that's going to be the selling and general administrative. Those are usually the period costs. Those are usually easier type of budget. That's an easier type of budget most of the time because period costs are often more predictable, meaning they're generally more fixed for the most part, and they will stay more constant oftentimes throughout the process. So operating budget. We're going to start off with the operating budget. We've got the sales budget. So the first step in preparing the master budget is the sales budget, which shows the planned sales units and the expected dollar from these sales. So first, we do need to figure out the sales first because everything else follows from that. When we think about things we produce and then sell in terms of units, such as guitars or something, then we would want to think about the units that we will then sell and then think about the unit price, and that's what will come out with our total sales that we will then have. Analysis of economic market conditions plus forecasts for customer needs is how we're going to determine this. And of course, in reality, we're probably going to look at the prior year. We're not going to base all of our information on the prior year, but we're probably going to say, how did we do last year? What are the market conditions for next year? How should we change that in order to meet the new market conditions coming up? And then we'll make our estimate based on that, make our price based on that. For example, in September 2015, Toronto Sticks Company sold 700 hockey sticks at $60 each. Toronto Sticks prepared the following sales budget for the next 3 months. So now we're going to sell hockey sticks here. And here's going to be our budgeted sales. So note we have it by month, and we're going to have the number of units that we believe we're going to sell being October 1,000, November 800, December 1,400, and then the total for that quarter, October, November, December, the fourth quarter of the year, being the 3,200, adding those three numbers up. And where did those three numbers come from? Again, that's a forecasted number based on the market and past conditions. And then we have the selling price being $60 per unit. Then if we multiply that out, 1,000 times 60 is 60,000. 80 times 60, 48. 14 times 60 is the 84, and so on and so forth, giving us our total for the quarter in this case. Once we do that, we have the production budget. So this is the number of units that we're going to need to make. This is how much it's going to cost. And now we can think about, well, how much do we need to produce? How many hockey sticks in this case do we need to produce in order to meet that? So we have a manufacturer prepares a production budget, which shows the number of units to be prepared in a period. The production budget is based on the unit sales projected in the sales budget, along with the inventory conditions. So what we're going to take a look at is we've got the budgeted ending inventory units of sticks. So we need to consider, when we think about the production, how many hockey sticks do we want to make? We probably want to have some hockey sticks left over at the end of the month or the quarter, whatever time period we are looking at. So we want to have the budgeted inventory, the budgeted ending inventory. How many sticks do we want at the end? How much cushion do we want? Because we don't want to make as many hockey sticks as exactly we're going to sell in case sales are higher than what we predicted. Then we're going to add to that the budgeted sales units, the amount of units that we believe we're going to sell, which we just figured out. That'll give us the required units needed. That's how many units we would have to produce if we had not have any on inventory from the prior period. So, but of course we're starting off not from scratch. We had last month probably had some hockey sticks left over from them. So we're going to subtract that out, and that will give us the total units that we need to produce. So once again, if we take a look at that calculation, beginning inventory, the ending inventory that we want at the end of the time period, at the end of the month or quarter or year, plus the amount that we think we're going to produce, those are the units that we figured out in the sales budget. That gives us the required units we need to produce if we didn't have any beginning inventory. But we do have beginning inventory, so we're going to subtract out the beginning inventory. That's how many units that we will need to produce. If we take a look at it in this format, then we have October, November, December, the final quarter. And remember that our units that we were going to produce, in this case, we're going to start off with the next month's budgeted sales. Why are we doing that? Because that's how we're going to figure out what we think our ending inventory should be. So we want our ending inventory to be 90% of next month's budgeted sales. That's how much cushion that we want in our inventory as of the end of the time period, just in case the sales are too high or higher than expected. That will give us our budgeted ending inventory. So that's what we think should be in there in this case at the end of October. That's how many we don't want to necessarily, we want to sell them, but that's how much we think that are going to be over the sale, the cushion in the inventory. And then we're going to add to that the budgeted sales, the amount that we believe will be sold. That will give us the required units available production. And then we're going to subtract from that the 1,010, the units that are already in there. And that'll give us the 710. Why does it have two dots? Because that information is going to have to be given in the problem. And then in November, we're going to take a look at the next month's budgeted sales times the same 90%. That gives us our estimate that we want in ending inventory. Again, we're going to add to that what we think we are going to sell in units. That will give us the required units of available production. And then we're going to subtract from that, and you can see that's coming from here, the beginning inventory, which of course was the ending inventory for the prior month. And that will give us the units that we need to produce for November. Same idea, if we take December, 900 is what we think will be in January. And again, it has the two dots because they're going to have to give us that information times the 90%, gives us the ending inventory. And then we're going to add to that the units we believe we're going to produce in December, or the sales in December. And that will give us the required units available production. And then again, we're going to take this beginning ending inventory from last month, and that the ending inventory from last month, and that's going to be our beginning inventory this month, and that then will give us the units to be produced.